Check out this recent interview where the role is reversed and I am the guest rather than the host. I am the one answering the questions on a recent episode of the Lifetime Cash Flow Through Real Estate Investing show. I talk about why compound interest does not build wealth and what does. You probably get the clearest explanation on how you get this higher inflation to help magnify your wealth rather than diminish it. And I also go over the 5 profit centers of real estate investing. Enjoy the show.
Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Cleef, and I'm thrilled that you're here. And I've got my friend on today, Keith Weinhold. Now, Keith's been on the show before. He's, I don't think he could be possibly any further away from me in the continental United States than where he lives. So he's in Anchorage, Alaska. And now he has, got his own podcast called Get Rich Education Podcast. And we're going to have some fun today. Welcome to the show, brother.
Rod, it's been a few years. Thanks so much for having me back.
It's been a long time. Yeah. So listen, can you just give us a little background again? Because it's been so long. It's okay. There's some redundancy from the last interview. So, tell us, a little bit more about your foray into real estate and where you're at right now. And then let's have some fun with some questions.
Yeah. For more than a decade now, I've lived in Anchorage, Alaska, because it fits what I love to do for skiing and mountaineering. Experienced real estate investors say, live where you want to live and invest where the numbers make sense. But most people don't actually do it. I'm actually doing it with a pretty humble bachelor's degree in geography from back there in Pennsylvania. I was a construction materials tester, and I had a friend that had bought a 4-plex building in Anchorage with just a 3.5% down payment. He lived in one unit and rented out the other 3. And I thought, hey, that could be a good way for me to start with a bang. I don't know a lot about real estate investing. I know it's made more ordinary people wealthy than anything else. So with this $295,000 4-plex that I started out with, Rod, in Midtown Anchorage, Alaska, I learned that with an FHA loan, I could put just a 3.5% down payment on the building, borrow the rest from the bank, essentially live for free from those tenants. And that's about all I knew. And Rod, before buying that building, I didn't even know what the terms cash flow and equity meant. And I think there's a bit of a lesson in that. Sometimes it's okay to start a little bit before you're ready, as long as you're not completely jumping into something.
Right. So I know you're, we've got a lot more doors now, and you've written books. You're a best-selling author. You've got your podcast that's, I think over 3 million.
Yeah.
So you're well into this space. Let's talk a little bit about. Let's start with this. I know you've got some strong beliefs and convictions around money, and so, about getting rich. I mean, that's the name of your podcast. So let's talk about how you feel about compound interest and explain why you feel like it really doesn't build wealth. Can you expand on that a little bit?
Yeah, well, you talk about the power of thinking differently. It all begins there. I like to live the mantra of don't live below your means, expand your means, much like I did with that first 4-plex building. I've learned over time, Rod, that I think so much of what conventional mainstream media feeds people is that people believe that compound interest builds wealth. And it's very easy to believe that. Just take a look at a chart. Just take a look at, say, 10% compounded in the S&P 500 over a bunch of years. My goodness, that chart goes parabolic. Oh, you want to get a part of that? No, you got to remember, when you look at that chart, that's only what 10% compounded does over time. What you're interested in is what's your return, not just what is mathematical. You've got to remember, compound interest, say you get a 10% return over time. I think a lot of people would agree that that's about the long-term average of the S&P 500. Well, it is, and people are satisfied with that. What happens when you subtract out 5% inflation? You're already down to a 5% return. What about not just inflation, but emotion and taxes and fees and volatility? Once you have all of those 5 simultaneous drags, go ahead and ask your financial advisor, hey, I see what a 10% return can do mathematically, but what's my return after inflation and emotion and taxes and fees and volatility? It's often less than 0. They're not going to like that question. I mean, if you ask any person, have mutual funds or stocks made you wealthy? All you're going to hear are crickets. So compound interest does not build wealth in the real world. Well, what does?
Right.
Leverage, financial leverage, like what you can do in be a savvy borrower of real estate tied to a cash flowing asset. So to bring it back to an example of leverage, Rod, that first $295,000 fourplex building, that was my first experience with leverage. I only made an $11,000 down payment and closing costs on it. And just 3 years later, the $295,000 building appreciated to $425,000. That's a $130K gain over a little more than 3 years with just an $11,000 down payment. That's the power of leverage. And some people say, how did that happen? It's because you get a return when you borrow as a real estate investor on both your down payment, and you also get a return on the money that you borrowed from the bank. That return goes to you, not the bank. So financial leverage is what builds wealth in the real world. Compound interest does not.
No, well, that all makes sense. You articulated it quite well. I mean, I knew all this, but it's good to hear it. So I know that you feel strongly about people not using. Why people shouldn't get their money to work for them. You hear that out there publicly all the time. Yeah. Have your soldiers go out there and work for you. Have your dollars as little soldiers going out there and working for you. What's your take on that comment?
You bring up a great point, because this is something else where it comes from this old-fashioned conventional finance school. And a lot of investors and everyday people and people that have 401ks, and they just have deductions taken out of their paycheck for their 401k. They just put their head down at work and they think, what can be better than getting my money to work for me in the market through my 401k? There can't be anything better than getting my money to work for me. That's what most people think, much like the compound interest thing. Right. I'm here to say, don't focus on getting your money to work for you. If you do, you're never going to get ahead. And what could possibly be better than getting your money to work for you? I mean, you know this, Rod, but maybe I'm just saying it in a different way. Don't focus on getting your money to work for you. Focus on getting other people's money to work for you. And even experienced real estate investors, Rod, I don't think they realize that when you are an investor in real estate and you get a loan for a cash flowing property, you're actually using other people's money ethically. Sure. 3 ways at the same time, because you're providing people with good housing. I want you to be providing good housing and being responsive to tenants and never get called a slumlord. But the way that you're ethically using other people's money 3 ways at the same time is you're using the bank's money for that leverage and for that loan, like I mentioned, using the government's money at scale for generous tax incentives. And thirdly, and most importantly, we are here on the Lifetime Cash Flow for Real Estate Investing show. You're getting that tenant's cash flow to service your debt. So using other people's money 3 ways at the same time, not just your own, the banks, the tenants, and the governments. That's the mindset shift. That's how you make more of yourself. That's how you not just live below your means, but how you transition into expanding your means.
No, I love it. Love it. Love it. Yeah. So again, a lot of this is for investors that are in the real estate space, they understand this. But you've articulated it in a way that really makes it very easy to get. And so let's talk for a minute. Let's step back for a minute and take a look at what's going on economically in this country and the current political climate and the trillions that are going to be poured into this economy that are basically being created out of thin air. Yeah. And what that's going to do to this economy. And I think without question, we're into inflation and it's going to ramp and could ramp very, very heavily. And so what is your opinion of all that? So let's talk about that for a minute, Keith.
Yeah, well, Rod, you said it, out of thin air. It's pretty funny. Fed Chairman Jerome Powell came out and even said so much on the show 60 Minutes last year. You got to give him a little credit for admitting it, but the Fed basically just prints money out of thin air. We're near the 50th anniversary of the dollar leaving the gold standard. President Richard Nixon made that decision, called the Nixon shock, 50 years. But in this past 50 years, a lot of people still act like they should save their money rather than borrow their money. Well, when the dollar was depegged from gold and you can print endlessly, that creates an environment for rampant inflation, which we saw in the 70s and 80s. Inflation has actually been muted for the past couple decades, but now, Rod, more recently, you see consumer price inflation exceeding 5%. And a lot of people don't know there's something called the PPI, the Producer Price Index, which now exceeds 7%. The Producer Price Index is how much it costs producers to make stuff, which can often be a harbinger of what the future consumer price inflation is going to be. And I just told you the PPI recently came in at more than 7%. So yeah, we are in this stepped up inflationary environment. Inflation makes most people poorer. It makes consumers poorer. So to step back for a moment, what is inflation? The classical definition is an expansion of the money supply. I think most people are aware of that. That's really the etymology and part of the root word of what inflation is. But the way that we think about it today and the way that most people apply the definition is your Chick-fil-A sandwich just went from $3.69 up to $4.09. It's that diminished purchasing power of the dollar. Inflation impoverishes most people, especially when their wages don't keep up commensurately with those higher 5 to 7% inflation levels like we have now. But as real estate investors, we're actually made wealthier by inflation. And I can tell you more about that.
Yeah, we're going to talk about that. But yes, I mean, there's just no question. We've seen it. You know, it's been very highly publicized in the lumber industry, for example. I just saw an article in Fox on how there's going to be a toy shortage for Christmas this year because because of COVID, but also on inflationary component to that as well. The costs of the raw materials to produce this stuff. So let's talk about the positive. So that's the negative. That's coming, guys. We just know it's coming. But let's talk about why we love real estate as it relates to inflation.
Sure. Inflation transfers wealth from lenders to borrowers, and inflation transfers wealth from savers to debtors. So I want to be a borrower and a debtor, which is something that scares most people. But a lot of people, Rod, I don't think they realize, lay people and such, that as cash flowing real estate investors, when we take out a loan for a property, of course, the tenant pays all of that mortgage interest for us, and they pay down some mortgage principal for us. And hopefully they pay us a little bit on top of that, called cash flow. I've actually coined the term that real estate investors win the inflation triple crown. We actually benefit from inflation 3 ways at the same time when we're debtors for cash flowing property. And one is called asset inflation. The second is debt debasement. And then the third one is cash flow enhancement. So let's just say you have a $1 million apartment building. Hopefully it cash flows. Hopefully you're pretty proud of that. It's operating pretty well. But with your $1 million apartment building, let's just say we have 10% inflation over time. It might not be a year, it might be a couple years, but over time, then your $1 million apartment building goes up in price to $1.1 million. All right, well, now you might be thinking, how in the heck am I any better off? Because I have 10% more dollars, but each individual dollar is worth 10% less. Aren't I right back where I started?
Right.
And the answer is no, because I said that you have a loan on this property. So if you have 200K of equity in that property and you get that inflation, your equity position goes from 200K up to 300K. That's a 50% gain, even though your dollar denominated price of your apartment building only went up 10%.
So that's cash on cash, guys. What he's talking about is a cash on cash gain versus a cash on purchase price. This is based on your equity in the deal. So please continue. Sorry.
Yeah, so your equity inflated up there. Mm-hmm. And then the second way, it's something a lot of experienced real estate investors, billionaire real estate investors, oftentimes don't even understand, this inflation profiting benefit that you get from the debt debasement. Let's just say in a different example, you have $1 million of debt on an apartment building. Mm-hmm. Okay, well, with 5% inflation, after 1 year, you only owe $950K in inflation adjusted debt. See, the bank doesn't ask to be repaid in inflation adjusted dollars, just nominal dollars. And again, your tenants are paying the interest on that the entire time. After year 2, you only owe the bank $900K. After year 3, only $850K in inflation adjusted dollars. You've got a $50K tailwind that you're probably not even feeling or thinking about. Most people don't think about that debt debasement advantage. And then the third leg of the inflation triple crown, cash flow enhancement. Your cash flow, and this is really important, the money you feel in your pocket every month goes up faster than the rate of inflation. And the short story there is because the biggest expense that you have as a property owner is your mortgage principal and interest, and that stays fixed for 30 years here in the United States, which is one of the few places where you can do that. This is huge. This is the money you feel in your pocket every month. So the inflation triple crown is price inflation, debt debasement, and cash flow enhancement. That's how you're winning when you're thinking bigger, when you're thinking differently, when you're on the next level beyond compound interest, when you're on the next level beyond only getting your money to work for you and employing other people's money. That's how you're winning with inflation. And inflation's only been greater lately, and it's positioned to continue to stay high for at least the next few months.
Yeah. Yeah. So let me ask you this. Do you, in your opinion, based on your interviews and research, do you feel like there's a COVID component to this inflation, or do you think that it's? I personally think it's happening regardless. But what are your thoughts on that?
A lot of economists that I talk to, they think inflation will settle down. They say the word that a lot of people don't like to hear. A lot of economists think it is transitory. Even if it is, my point is, if we've had stepped up inflation of 5 or 6% and then just say it tapers off to 3%, well, it's not like inflation went down, and we did get up on a higher plateau when inflation went up 5 to 6% per year. We already got up there. That's not coming back. No one expects there to be deflation. So regardless, we've already experienced the inflation. So that's why I like to be in a lot of good debt. Rod, the futurist Buckminster Fuller, he said something that relates to this. Buckminster Fuller said, don't fight the forces, use them. With the United States having almost $30 trillion in debt, we're incentivized to debase our debt because it makes it easier for us to pay back our international creditors. So therefore, the United States has an incentive to keep inflating and keep printing. So we're aligning ourselves, much like Buckminster Fuller said, don't fight the forces, use them. If we think more inflation's coming, we want to tie up more long-term fixed interest rate debt to cash flowing real estate.
Interesting. Yeah. So you talk about real estate investors being paid 5 ways simultaneously. Can you expand on that? Because I know you've written about
I can.
that too. Okay.
I'm talking about all these different ways, all these different facets for doing things. And, again, most stock and everyday mutual fund investors, they're only used to getting paid one way. And that's with a capital gain, which is harder to do than what one thinks, because you need to buy low and sell high. And you're pretty much always in that I need to buy low and sell high trap in order to be profitable. And your emotions often run against that. You want to sell when things are low because you're discouraged that they've been going down. And what you want to buy when things are high because you justify that with momentum and fear of missing out. Some stock investors are also paid a second way if they happen to have a dividend paying stock, but the average yield on a dividend in the S&P 500 has been less than 2% lately. But so for the most part, most people are only used to getting paid if they have a capital gain, which they need to pay tax on if they're invested outside a retirement plan. But as real estate investors, we get paid 5 ways at the same time. Number 1 is appreciation. Number 2 is cash flow. The third one is what I've called an ROA, a return on amortization, as the tenant makes that principal payment for you. That's a benefit you don't actually have in your own home because you had to pay down the principal and you had to work for those dollars in your own home. The fourth are a huge basket of tax benefits. And then the fifth one is that inflation profiting benefit that I explained before about how inflation debases your debt, since the bank doesn't ask to be repaid in real inflation adjusted dollars, only nominal dollars. And this, Rod, and this sounds blasphemous to some people that haven't considered it before. This is why anything less than a 20 to 25% annual return from real estate investing is actually a disappointment because you have 5 simultaneous profit centers. And when you have all these profit centers and, you have your money working so many ways at the same time, it's interesting, Rod. Maybe there's been a time in your life where you felt like you've wanted to be more offensive with your investing, and other times where you've wanted to be more defensive and safe.
Right.
And when you're paid 5 ways, you're actually being offensive in 2 ways with the appreciation and the cash flow, and defensive 3 ways with the return on amortization, the tax benefits, and the inflation profiting benefit from the long-term fixed interest rate debt. So you're being both. You're able to play on offense and defense. You're able to play both sides well at the same time when you have 5 simultaneous profit centers like you do with real estate. So really the lesson there is make your money do multiple jobs. You have the ability to do that.
Yeah, love it. Love it. Yeah, you give a lot of clarity around investing. There's a lot of clarity with that. So, last topic, which is my favorite that I want to talk about, because I know you talk about it, and that's mindset. And why don't you take a few minutes and talk about the power that you believe comes from that topic.
Yeah, wow, there are so many ways I can go there. I think it's embodied with the saying, don't live below your means, expand your means. What's that really mean? There are a lot of ways to go with it, but when we think about how would you rather spend 30 minutes? Some people think a good way to spend 30 minutes is waiting in line for a free Chipotle burrito for 30 minutes. Instead, you can actually be learning about how to build wealth and learn about some of these wealth building concepts, and understand, for example, why you probably don't want to be debt free. Right. You want to be financially free. Right. That's a mindset shift. Debt free just means you don't owe anyone anything. It doesn't make sense to be debt free when interest rates are less than the rate of inflation. You're actually diminishing your prosperity when you're trying to be debt free. Financially free means you can do whatever you want to do whenever you want to do it. I mean, I know you and I do this, Rod. In fact, I remember we were in Italy at the same time, and you and I and each of our wives were communicating back and forth. Right. We're like, hey, I mean, this is the life we designed for ourselves. Why would you want to live any other way? So kind of structure your life to be financially free rather than debt free. And if debt continues to scare some people, I'd just like to rather have you contemplate, if you learned about a person that was $10 million in debt, and that's all you knew about that person, what would you think about them? What would you think about their financial condition? Maybe you think it sounded pretty shabby, $10 million in debt, a debt decamillionaire, if you will. I've talked about that on the Get Rich Education podcast. You might want to be a debt decamillionaire because it's just a 5% inflation rate. If that debt's outsourced for you, you have a $500K annual tailwind. And the other part of the mindset of a person that has something that you might consider a lot of debt, 8-figure debt with $10 million in debt, what else does that probably say about that person's financial condition? It probably says that they're pretty financially savvy, because to even get $10 million in debt, you must be pretty credit worthy. Most people couldn't get $10 million in debt. Expand this stranger's picture that's $10 million in debt. They might have $50 million on the asset side minus $10 million in debt equals a $40 million net worth. So you got to kind of contextualize that. So some of this can help erode this mindset of I've got to be debt free. It's just not the most efficient thing to do.
Yeah, no, I think Ramsey's hurting people with that, frankly, because they're missing. You're missing the other part of the equation and the incredible value of debt, like you just said. So no, couldn't agree more. Well, listen, brother, I really appreciate you coming on the show. You've given a lot of clarity to what it is that we do, guys. It's Get Rich Education Podcast and same name YouTube channel. Appreciate it. Good to see you. Say hi to the bride for me, and I'm sure we'll talk soon, my friend.
I love chatting about it again. Take care, Rod. Wish you well. Bye-bye.